The median American household has a net worth of approximately $192,000. That sounds like financial progress. What almost nobody mentions is that $170,000 of that figure is trapped inside the walls of a house, an asset the family cannot spend, cannot eat, and in most cases cannot sell without simultaneously destroying the place they live. Strip out home equity, and the actual liquid deployable wealth of the median American household collapses to somewhere around $22,000. A number that, against the backdrop of median annual expenses, represents less than 4 months of survival. Not 4 months of comfort. 4 months of survival. The number your bank app shows you every morning is not your financial reality. It is a rendering of it, a thumbnail, a partial image of a much more complicated picture, and the parts the thumbnail leaves out are usually the parts that determine whether you are building something real or watching a ghost accumulate where your wealth should be. Something important is about to become very clear. Most people who feel financially behind are not imagining it. They are measuring the right anxiety with the wrong instrument. They look at their checking account balance, maybe their 401k total, and they construct a story about how they are doing. And that story is almost always wrong. Not because they are bad at math, but because no one ever told them they were reading the wrong ledger. Here is what that costs in real terms. A household earning $85,000 a year, the rough median household income in the United States, and saving diligently at a 10% rate, accumulates roughly $8,500 in new savings annually. If they hold those savings in a checking or savings account earning less than 1% annually, which roughly 43% of Americans still do according to Federal Deposit Insurance Corporation data, they are losing ground to inflation at a rate of approximately 2 to 3% per year in real purchasing power terms. Over a decade, that is not a rounding error. That is the difference between having $85,000 in deployable wealth and having the equivalent of $67,000 in actual purchasing power. A silent $18,000 evaporation that never appears as a loss on any statement they receive. The problem is not income. It is not effort. It is the architecture of how wealth is held, tracked, and measured. And by the end of this, you will be able to read that architecture clearly and see exactly where the leaks are. To understand why the average person's understanding of their own net worth is structurally distorted, you have to go back to 1978. That year, the United States Congress passed the Revenue Act of 1978, which embedded Section 401k into the tax code almost as an afterthought, a provision originally intended to give executives a tax-advantaged supplement to their pensions. Within 5 years, benefit consultants had reimagined it as a primary retirement vehicle. By 1985, roughly 30 million Americans were enrolled. By 2023, that number had grown to approximately 70 million participants holding over $7.3 trillion in total assets. The shift mattered enormously for one structural reason. 401k balances are not wealth you can access. They are deferred tax obligations wrapped around semi-liquid assets locked behind a penalty wall. Withdraw before 59.5, and you pay a 10% early withdrawal penalty plus your full marginal income tax rate. In practical terms, a $100,000 balance for a household in the 22% tax bracket is actually worth roughly $68,000 in a crisis scenario. The balance reads as wealth. The reality is conditional wealth, a figure that only becomes real under very specific circumstances in the very distant future. Then came the home ownership expansion. The Federal Housing Administration had been systematically expanding mortgage access since the 1930s, but it accelerated dramatically through the 1990s and early 2000s. By 2004, U.S. home ownership rates peaked at 69.2%, the highest in recorded American history. Home ownership was sold explicitly and repeatedly as the cornerstone of personal wealth. Your home is your biggest asset became not just a cultural belief, but practically a financial policy position. The problem is that a primary residence is an asset in the accounting sense, but a liability in the practical sense. It costs property taxes, insurance, maintenance, and opportunity cost every year. You cannot diversify it. You cannot spend it. It is illiquid by design, and its value is tied to factors: local employment, school district ratings, municipal, bond quality, regional migration patterns that you have virtually no control over. The result of these two parallel policy tracks, the 401k revolution and the home ownership push, is a generation of Americans whose balance sheets look substantial on paper and feel precarious in practice, because the substantial parts are either locked up, conditional, or immovable. The mechanism underneath all of this has three components, and each one compounds the last. The first is what you might call nominal wealth confusion. Human beings are naturally anchored to nominal numbers, the face value of a figure rather than its real, inflation-adjusted, liquidity-discounted equivalent. When a 401k statement arrives showing $240,000, the brain registers $240,000. It does not automatically subtract the 10% early withdrawal penalty, the deferred tax liability at current marginal rates, the inflation discount for the decades before that capital is accessible, or the sequence of returns risk that could slash it by 40% in a single bad decade preceding retirement. The $240,000 is a legal fiction dressed as a financial fact. It is the best-case scenario presented as the current scenario. And because it feels real, people calibrate their sense of financial security to a number that does not exist yet. The second component is illiquidity drag. Illiquidity is not just an inconvenience. It is a structural tax on wealth building, capacity. When a large percentage of a household's net worth is locked in home equity and retirement accounts, the household has no deployable capital to seize asymmetric opportunities. They cannot invest in a private deal. They cannot bridge a 6-month income disruption without incurring penalty costs or debt. They cannot rebalance toward assets that are performing. They are fully invested in a fixed portfolio they cannot touch, while the financially mobile, those with liquid assets, can move, reposition, and capture gains that the locked-in majority never access. Think of it like this. Owning a warehouse full of gold you can never enter is not the same as owning gold. The warehouse is your net worth on paper. The inability to enter it is your financial reality. The third component is the displacement effect. Because people believe their ghost. Net worth is real. They adjust their behavior around it. They feel wealthier than they are. They save less than they should. They spend more comfortably than the situation warrants. Federal Reserve data from 2022 shows that households with substantial home equity saved at a rate 34% lower than renters at equivalent income levels. A finding that initially seems counterintuitive until you realize that home equity creates the psychological sensation of wealth without delivering the functional capacity of it. The displacement effect means the ghost is actively crowding out the real. And the more convincing the ghost, the less urgency people feel to build something tangible beside it. If you have been tracking this closely, you already understand something that most people in your income bracket do not. And that gap in understanding is exactly the edge this channel exists to give you. Subscribe now, because the next 4 videos in this series go several layers deeper into the structural mechanics of how wealth is actually built versus how it is reported. The people who understand this first move differently. Be one of them. Here is what almost no one is willing to say plainly. The advice to build net worth, as it is commonly taught, is functionally meaningless without a distinction between ghost net worth and functional net worth. The dominant assumption embedded in virtually every personal finance article, retirement calculator, and workplace benefits presentation is that all net worth is equivalent, that a dollar in home equity counts the same as a dollar in a liquid brokerage account, which counts the same as a dollar in a 401k. That assumption is wrong. It is not approximately wrong or slightly misleading. It is structurally, consequentially wrong in ways that shape the financial decisions of millions of households every year. Consider what the data actually shows when you separate net worth by liquidity tier. The Federal Reserve's survey of consumer finances found that among households in the third wealth quintile, the solidly middle class, median holdings of liquid financial assets outside retirement accounts were just $6,500. These are not poor households. These are households with incomes between roughly $52,000 and $93,000, with median reported net worths between $80,000 and $300,000. But the liquid, deployable portion of that wealth was $6,500. That is not a wealth gap. That is a liquidity crisis wearing a net worth costume. The myth says, build net worth and you will be financially secure. The reality says, build the wrong kind of net worth and you will feel secure while remaining financially brittle. Home equity cannot cover a medical emergency. A 401k cannot fund a career pivot. A number on a statement cannot do anything until it is converted, and conversion always has a cost. Your net worth is not one number. It is at least three, and only one of them will be there when you need it. This is the moment to release the most damaging thing most people carry about their financial situation. The belief that where they are is their fault. It is not. The architecture described here was not designed by you. The 401k structure that front-loads the appearance of wealth while deferring its accessibility was written by legislators and formalized by corporations seeking to offload pension obligations. The home ownership ideology that conflated a primary residence with a financial asset was constructed over decades by real estate lobbies, mortgage lenders, and government housing policy. The financial literacy vacuum that left most households unable to distinguish between nominal and real wealth, between illiquid and liquid assets, between ghost net worth and functional net worth. That vacuum was not an accident. Informed consumers ask harder questions, make fewer impulsive decisions, and are harder to profit from. You were handed a measuring system designed to show you a number that felt reassuring. The fact that the number obscured more than it revealed was a feature of the system, not a bug in your reasoning. Understanding this is not an excuse to stay where you are. It is a reason to start from reality instead of from shame. Clarity is not a consolation, it is the only usable starting point. So what do you actually do with this? There are 3 moves that reorient financial strategy around functional net worth rather than ghost net worth. And none of them require extraordinary income or sophisticated financial instruments to execute. The first is the liquidity. Audit. Before making any new financial decision, calculate your liquidity ratio. Divide your total liquid accessible assets, checking, savings, taxable brokerage, money market funds, by your total reported net worth. If that ratio is below 15%, your financial architecture is fragile regardless of what your total net worth figure says. The target for a household in the wealth-building phase, roughly ages 28 to 52, is a liquidity ratio of at least 20 to 25%. This does not mean pulling money out of retirement accounts. It means redirecting a portion of new savings into liquid vehicles, a taxable brokerage account, a high-yield savings account yielding above 4%, before adding additional illiquid assets. The 15% floor is your early warning. Threshold. The 20 to 25% range is your operating target. The second move is debt-adjusted net worth tracking. Most people calculate their net worth by adding assets and subtracting liabilities. That part is correct. What most people not do is apply a liquidity discount to illiquid assets before calculating the total. The practical method is straightforward. Apply a 25% liquidity haircut to home equity, reflecting transaction costs, market timing risk, and the cost of housing replacement, and apply a 20% haircut to retirement accounts under age 59 and a half, reflecting taxes and early withdrawal penalties. A household that does this for the first time typically sees their effective net worth drop by 30 to 40% from the reported figure. That drop is not a loss, it is an honest measurement. And the household that measures honestly builds a real plan, while the household measuring optimistically builds a ghost. The third move is the functional wealth floor, separate from net worth. Entirely calculate your functional wealth floor. The minimum liquid capital required to cover 6 months of essential expenses plus one major asymmetric opportunity, the kind of investment, career move, or business positioning that only becomes available to people who have deployable capital. For most median professionals in premium countries, this floor falls between $30,000 and $60,000. If your liquid assets are below that floor, every other wealth-building activity, additional home equity, additional retirement contributions, is premature optimization. It is insulating the roof before building the foundation. Hit the functional wealth floor first, then optimize allocation. The order matters more than the amounts. The median American household has a net worth of approximately $192,000. You heard that at the beginning, and it probably sounded like a modest but real number, the output of decades of working, saving, and building. Now you know what is inside it. You know that $170,000 of it is locked in an illiquid primary residence. You know that most of the remainder sits in retirement accounts that come with tax liabilities, penalty structures, and sequence of returns. Risk that the balance never displays. You know that liquid deployable wealth for that median household is roughly $22,000, less than 4 months of expenses, sitting in accounts that are actively losing ground to inflation while the headline number continues to look reassuring. The $192,000 is not a lie in the technical sense. Every asset is real. Every figure is reported accurately. The lie is in the implication. The implicit suggestion that this number represents financial security, financial freedom, or a meaningful buffer against the random volatility of a real human life. It does not. And the people who understand why it does not are not the ones panicking. They are the ones quietly rebuilding their financial architecture around a different, more honest set of numbers. That is who you are now.